Picture yourself opening your tax return and seeing a capital gains tax bill on investments that you never sold. Sounds unfair, right? That's exactly what happens with some mutual funds, and most investors don't even realize it. Today, I'll break down the key tax differences between ETFs and mutual funds so you don't get caught paying more than you need to. So, how do you avoid unnecessary taxes on your investments? By the end of the video, you'll know the key tax differences between ETFs and mutual funds and why they matter, how ETFs help you avoid surprise capital gains taxes, and when might a mutual fund actually be the better choice for your portfolio. Imagine that you live in a neighborhood with a homeowners association. One day they decide to renovate the community pool and send everyone a bill for their share of the costs. Even if you never use the pool, you still have to pay for it. That's how a mutual fund works. When other investors sell their shares, the fund manager might need to sell stocks inside of the mutual fund to pay those investors who are exiting. And that sale could trigger capital gains taxes, which are then passed on to all the investors, even if you didn't sell a thing. ETFs, on the other hand, work a bit differently. You pay taxes only when you sell personally. Now that you see how mutual funds can trigger some unexpected taxes, let's break down why this happens. Mutual funds versus ETFs are very different when it comes to taxes. Mutual funds distribute capital gains annually when fund managers sell stocks for a profit inside of the fund. Even if you didn't sell your shares, you still get taxed on those distributions. This means you can owe taxes on gains you never really wanted to realize. ETFs avoid passing capital gains to investors. So, when an ETF investor sells, they're selling to another investor, not forcing the fund manager to sell the securities inside of the ETF itself. This prevents capital gains distribution for the remaining shareholders. However, if an ETF sells stocks inside of the fund, those realized gains still lower the fund's net asset value. This doesn't create a direct tax bill for the investor, but over time it can reduce total returns. Here's an example of a mutual fund and one of an ETF. With a mutual fund, if many investors sell before year end, the fund manager might need to sell appreciated stocks, creating a tax bill for everyone. An example with an ETF would be if an investor sells, the ETF structure ensures that no capital gains are passed through to other investors, but the fund's realized gains still impact performance. If a mutual fund still makes sense from a tax perspective, when would that even be? Even though ETFs are generally more tax efficient, there are some times when mutual funds might be the better choice. In 401k and IRA accounts, capital gains tax don't really matter as long as the funds remain inside of those accounts. So a mutual fund's tax inefficiency really isn't an issue. Also, if you want active management, mutual funds typically offer more choices than an ETF. However, there are some tax-aware mutual funds that can be even more tax efficient than ETFs. Some mutual funds will use a strategy called tax loss harvesting to reduce the taxable distributions. And in some cases, for the funds that are really good at what they do, they can actually outperform ETFs in tax efficiency. One of my clients had this exact concern. If ETFs never pass through taxes, how can a mutual fund ever be better? Well, the answer to that is that there are some specialists in the mutual fund space that focus on tax efficient growth, and they tend to come out on top. If you're looking for funds like this, make sure when you're looking for them that you see in the fund's title something along the lines of tax aware or tax managed. If you don't see that in the name of the fund, odds are the fund is not tax managed. So now, before you decide which one is right for you, let's talk about the biggest mistakes some investors make when choosing between ETFs and mutual funds. Mistake number one, ignoring taxes in a taxable account. Some investors hold actively managed mutual funds in taxable accounts that can trigger huge annual tax bills. A solution to this is that if you're investing in a taxable account, ETFs or tax managed mutual funds are usually better. Mistake number two, assuming that ETFs are always better. Some ETFs have low liquidity or high bid-ask spreads. Basically, the spread is the difference between what you would pay for the ETF and what someone who already owns the fund would sell it for. And a wide spread makes it more expensive to trade an ETF. The solution to this is to choose ETFs with high trading volume and tighter bid-ask spreads to avoid that hidden cost. Now you know the key tax differences between ETFs and mutual funds. But here's the thing. This is just one piece of the tax puzzle. If you really want to grow your wealth while keeping more of your investment gains, you need to structure your entire financial picture the right way, choosing the right accounts, the right strategies, and the right fund managers. In my next video, I break down 3 powerful tax strategies that'll help you keep more of your money while maximizing long-term growth. Click here to watch it now.